Okay, guys, so I'm going to show you how to sell verticals. Essentially, what you want to look at it is like this. You want to sell a t-shirt. This is probably the simplest way to look at it, and I'm going to make it like very simple so that way you'd understand what I'm talking about. So you're going to sell this t-shirt, and you're going to sell it for $4, okay? Now, the only way to sell the t-shirt is if you buy it. So if you don't have a t-shirt to sell, you cannot sell it. You can't just like, tell someone, no, I'm going to give you a t-shirt and basically not have the t-shirt available. So what you have to do is you have to buy the t-shirt. So let's say you get it from China for $1, right? And then a few costs in between, getting it shipped over, stuff like that, blah, 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 management costs, etc. So you essentially make $3, but let's say you make $2.50 with all the other costs in between. And that's basically really the simplest way to look at a vertical. Is if you picture it like that, you'll understand that you're basically selling something that you're buying at a cheaper cost and obviously selling it at a more expensive cost. And that's what you do. That's how businesses work. So if you look at the options, you can look at this, for example. You can look at the S&P. Okay. So right now the S&P is at 3753. It's closed right now. And you're going to assume that it's not going to go higher. Or you got to make an assumption that, okay, let's say this is your S&P right now. It's at 3753. And you're going to assume that it's not going to go below this support right here, for example. And you're going to sell right below it. Now, the thing with verticals is that you don't want it to go into your price on expiration. You want it to not be in that price, because what you want it to do is you want it at the end of expiration, an option is basically worthless. So if an option is basically worthless, that means no one bought it. So what happens is that even though you bought the option at $1 and you're selling it at $4, unlike not having a buyer in verticals, you're your own buyer, so you're making your own profit. So you're buying the vertical at $1, but you're getting it back at $4 a share. And that's really what verticals are. So it's that simple. I mean, it's pretty simple. So what you're going to say is, let's go back to here. So you're going to say what? 37.13, right? You're going to assume that's not going to go below 37.13. So you're going to go to the trade, to your options. You look at the 37.10, right? You're going to sell that, and you want to buy it at a cheaper price, which would be 37.05. Don't look at the numbers right now. Don't worry about that. But essentially, this one is like $6.50 actually, and this is $5. So you're selling it at $6.50 and you're buying at $5. You're making $1.50 a profit, and that's really what verticals are. And you wanna basically buy closer to the money, because the closer an option is to the price, it's going to be more expensive. See how it's like 13 and it's 15 around this price, but as you go further away, the puts become cheaper, because the likelihood of the S&P falling this far down in one day is very low. So you can get it. They don't care. They'll sell it to you, because they know that price is not going to get that cheap. And so same thing with calls. On this side is the calls. So over here, they're like $15. And as you get further away from the calls, the likelihood of the market hitting 38.15 is very low. So they'll sell it to you for 80 cents each. But if you bought that same thing further out, it's even cheaper. So you want to buy it further out and you want to sell it further in. So what you got to do is you got to set this up to a vertical spread. I have this on, what do you call it? On just simulated trading, so you're not going to see it over here, but let's see if I can get over here. Yeah, okay, here's the verticals. So they have them set up for you. You don't have to use these numbers. You can make it further away, but it's going to cost you more, because your profit's going to be wider, so it's going to cost more to buy, and the risk is going to be higher, because now you have a wider risk, and actually the risk is going to be lower, because if it goes in the price, you have such a big wide gap that it has to go further in for you to really lose money. And that's a little bit more complicated, but if you look at this, for example, this is expiration March. So we don't want to do March expiration. We want to do something closer. So let's go to the option chain. Let's do Wednesday this week. Okay, so it's a lot cheaper because the expiration's closer, and you kind of have the idea of what it's going to expire at. But anyway, let's just take an example over here. 37.35, 37.30. Let's say you want to sell this. So you're going to make 75 cents a share. You're going to buy at 37.30, you're going to sell at 37.35. You can make 75 cents a share. So if you look at that, 75 cents a share, one call is equal to 100 shares, right? So if you just sold one call, you'd make $75. And if you let this thing expire, you actually make all your money back, all the management costs, which is like commission and all that. You should be able to make that back. And that's really all that verticals are. They're not that complicated. But the complication is, the complicated part is where you're going to put it. What I normally do is I wait near expiration date, and then I look for something that is a support or a resistance. So for example, at 4 o'clock, you got 4 hours left of the market. So market breaking a 4-hour resistance is very unlikely. Okay, it probably will come down here, and once it gets there, it's going to go back up to wherever the resistance is up here. I mean, support over here, resistance up here, and come back. And if it's a 4-hour bar, it's going to take at least 8 hours for this to break, because it's got to go all the way back up and then come back down. So for it to go all the way back up, it's going to take 4 hours. Come back down, it's going to take 4 hours. So what I do is I put the support at a place where I put the vertical at where there's a support. But you want to be close enough that you want to make money. You don't want to make like 10 cents. You don't want to make like a 1-2% profit. So that's the other issue. So when you see something like this, 37.19, this is like, 37.20. So you can say, okay, at 12:30 you see this. So you go to your options and you say you want to do a 37.20 and a 37.15 spread, 50 cents, right? And so if you look down here, it puts it all in perspective for you. And let's say you want to buy this, right? Let me just try to pull this up. Anyway, it automatically tells you, to sell 10. So you can change that. You can look at the cost of it and everything, and your credit is actually it's $1.25 credit. So you make $1.25 per share. So you're gonna sell 100 of these. So if you have $1.25, you're gonna make $125 from just one actually 10. It's gonna be 10. So if you do one of these, you'll make $12.50. But it's a lot cheaper, You're gonna if you sell like 10 options, it's gonna cost you around maybe a couple $1,000, and you make like $125. It's not bad. Like maybe 1,000, 1,500 probably be around 10 at this time. But you probably want to make $1.25. But it costs you per option a certain amount of commission depending on who you use your broker. So that's basically how you do options. So what I normally do is I do the same day expiry. I do it around 12:31. You can see where the market's headed. You could see the trend for that day. So if you look at like a trend, do a 1 hour or 15 minute, and you see, okay, look, the trend is going up. So the likelihood of this market to come down this way is not that likely. So then I look at it, and I look at the support in that area, and this is the support. And then I say, okay, let's sell it over here. Okay, you can do it more riskier. You can go to like a 15 minute, but it's risky. And you can say, oh, look, there's a nice support here. So let me do a 37.35, because this is 37.37 over here. So you can go to 37.35, and instead of making 75 cents a share, you can make, 50 cents a share, you can make 75 cents a share. But let's see, it's probably more than that. It's $1.75 credit. So it's about 50 cents more, which is good. It's $500, So this is what you do. I do it on Monday, Wednesday, Friday, because S&P, it has 3-week expirations. If you do like Apple or something, you can do something like that. Let's say you look at Apple, and you say, okay, Apple's going to go to, it's just, Apple's on fire, and it's going to go higher. It's going to go like, whatever. It's going to go to 150. let's say you say Apple's going to go to 139. Let's just do this. 139 was the highest, right? So you say it's going to go to 139. So what you can do is the expiration they do every Friday. So if you think Apple's going to pass 139 or go to 139 before Friday, you can just trade the option, right? At like 135, 136, make 55 cents a share. If you want to be risky, you got to go here. But the thing is that if it doesn't go in your price or past it, you're going to lose money. So that S&P is a lot safer, and it's 3 times a week. You can make about a 15-20% return on it, and that's essentially what I do. Is I just look at this as Monday's expiry. Right now, these numbers are a little bit higher because the market's not open. It's Sunday, but it'd probably be like this probably be a lot cheaper. You're not going to make this much money, so. I do this if I think the market's going up. I do puts because you think if you sell puts, the likelihood of the market falling is not likely. It's just going to keep on drifting away. And what happens as prices go higher? The puts get cheaper. And if I think the market's going to fall or it's not going to reach a price, then I do a call. And so I'll say, okay, the market's not going to hit 37.80. Okay, so I'll do the 37.80, 37.85, and then the market never hits on close, I made the money. Now the thing is that this is a S&P futures, which I like better. You can do the SPX, has the same expiries, so does the SPY. It also has Monday, Wednesday, Friday, so you can trade this 3 times a week instead of doing just once on just an individual stock. But whatever you like, you can do these SPXs. It's pretty much the same thing. Costs a little bit more, and the return is not as great. And you can do also SPY. SPY is a lot cheaper, so you make less, but you can buy more. So it all works out the same, really. I mean, you can do any of those, but I just like doing the futures. I think the return is better, but more than likely, the futures the price can keep on going after hours, so you have to be a little bit careful. 405 is really where they kind of expire. Although you cannot trade them after 4 o'clock, the options, they really let them expire at 4:05 p.m. And SPX and all that is at 4 p.m. And you just let it expire. If it doesn't go in your price, just let it expire. If you think it's coming in your price or something, 10, 15 cents into your price, just get out of there. It's better to lose a little bit of money, because if it goes right through your price, you will lose all your money. So do not risk that. If it's like 369 and this S&P, this SPY, and all of a sudden it goes to 366, get out of there. It's better to lose one day and fight another day and win, and just make your money back. You then take a chance and let that go all the way in and think, oh, it's going to be 370 by the market end, and it's 5 minutes left. That's a high risk you're taking. I wouldn't do that. So that's really the easiest way to really explain them.